Hey, Steve Smith.
Hey, Brett Starr. How you doing, sir?
I'm doing great. How are you?
Doing great. It was nice seeing you recently, live and in person again.
How long has it been since we've spent 3 days locked up in a conference room together?
Approximately 38 years.
About 38 years. Yeah, I was thinking the same thing.
About 38 years.
I think it was actually about 3 years, but it felt like 38 years.
Yeah.
It was great. I barely survived. It reminded me of like why I can't travel for business anymore, because I'm going to die on the road.
Yeah. I really enjoy not traveling on business anymore. Yeah. So that was a nice little reminder.
Well, I'm Brett Starr, the CEO and founder of the Starr Conspiracy, and I'm joined today by Steve Smith. Introduce yourself, Steve.
I am Steve Smith. I am a partner and the chief marketing officer of the Starr Conspiracy.
And we are talking today about the need to raise your game, specifically in brand and marketing, but under the broader umbrella of customer experience. So let's break this down a little bit, Steve. Let's wax philosophical for a moment.
All right. Wax on, wax off.
It is one of the most productive and yet strangest and most uncertain times in work tech history. Go.
Not an overstatement. Yeah, it is. I think that it's a very paradoxical market that we're in the middle of. I mean, on the one hand, we're coming off years of record investment. And there are still plenty of companies out there that are spending lavishly on growth, but there's definitely a reset in the market amongst investors of wanting to see solid business fundamentals beyond just growth.
Yeah.
And there is really kind of a retrenchment amongst a lot of companies. And I think that even though demand and business need for workplace tech solutions remains strong, I think that you're seeing a bit of a gut check moment going on with work tech companies.
Yeah, I agree. So let's break down and unpack and any other metaphor that makes sense here to kind of paint the picture here. More investment than ever. So talk about the previous 2 years of investment in work tech. And when I talk about investment in work tech, in this context, I'm talking to shareholders about how much money has been invested in work tech startups or work tech companies who have been around who are seeking growth capital. What's happened in work tech investment over the past couple of years?
There's been a lot of money flying around. Just last year, there was 30.8 billion, or is that right?
Yeah.
30.8 billion. Well, that really just sounds so,
I know.
So
it sounds weirder every time I hear it or say it.
Yeah. So 30.8 billion coming off of 2020's 9.2 billion.
Which at the time, 9.2 billion was like unimaginable, right?
Yeah, it was stupefying.
Yeah. And we thought that's the peak.
Yeah. 21 was triple that.
Yeah.
And even this year, I mean, and there's all this hand wringing over the investment slowdown. We're at 17.6 billion with the rest of Q4 to go. So, in all likelihood, we're looking at it's going to be probably a $20 billion year, which is easily the second best investment year on record. So lots of money flying into the market.
So by the time we get to the end of this year, there's going to have been $50 to $60 billion invested in work tech companies.
Yep.
And how would you compare that to, say, the last 5 years, 10 years, 15 years, 20 years?
That's like more than invested in all of the previous, years combined.
Ever.
Going back to, I think even beyond the 90s, I think going back to the Burroughs adding machine in the 1800s.
Yeah. So basically, by the time we get to the end of this year, the last 2 years, which will have been 2021 and 2022, have seen more investment in work tech companies than all of the other years in history combined.
Yeah. So, I mean, to give it kind of the appropriate context, we've got records of work tech investment going back to the late 90s. And from 1998 to 2019, so that's what, 22 years, there was approximately, $25 billion worth of, $25.3 billion of investment.
Yeah.
Since the beginning of 2020, we're tracking toward $60 billion of investment. So, easily double, everything that came before 2020.
Yeah. So you got all these investment opportunities, all these investment rounds, early rounds for new startups, late rounds for companies who are, seeking astronomical growth at already high numbers.
Mm-hmm.
And what has that done? Obviously, these are all leading questions, but what has that done to the number of work tech vendors who are in the market today versus what it might have looked like 5 years ago or 10 years ago?
It's completely exploded. I mean, I think that if you were comparing it to where it was 10 years ago, I think that you've probably seen a 5 or 6-fold increase in the number of work tech companies.
Yeah. And I think it's more, but, it's like there are, because of the amount of investment, which actually began to increase several years ago, but then went parabolic, right? As the kids in crypto say, it went parabolic. And you've got parabolic investment in work tech. And that has not all been flowing into existing companies. It has created a whole new class of new work tech companies. So in the past where, you might have looked at we get hired frequently to do competitive analysis or market maps or, whatever. And it used to be extremely responsible, 5-7 years ago to look at maybe the top 10 companies in a market segment as, narrow as performance management or, well-being or just insert, work tech category here. Now there are so many vendors that to be responsible about trying to create a market landscape, you're looking at 40, 50, 60 vendors. And most of those vendors either are the small minority are, bootstrap companies who have been around for a long time and have grown significantly or major brands in the space. Mm-hmm. But you have half of any market is filled with startups that have received 40, 50, 60, $100 million in funding. And so it's almost an order of magnitude in terms of how many competitors there are in every segment within work tech. And so, continuing to build this logic, you have more investment than ever by if we had predicted it, which we did, if we had predicted it and told everyone that, in the next 3 years, there's going to be more investment than all of the other years combined in history, people would have said you're crazy. But it happened. And here we are. And that's resulted in more competition, more companies. And you can't there's no micro segments anymore. Anything that used to be a micro segment, like a hot desking, maybe there was 3 vendors of note and now there's 20, right? So there are no micro segments anymore. Every segment is hyper competitive from the moment that someone draws it on a whiteboard. I have this idea. There's 20 other, probably 200 or 2,000 other people having the same idea. And, 50 of them are going to get funded. Right. And so the competition is intense. So more funding than ever, more work tech vendors than ever. What's going on with buyers? What's strange about buyers right now?
I mean, it's just a bunch of things. Buyers, have almost, 20 years of experience buying SaaS solutions at this point. And, a lot of them are on, a second or third round of SaaS implementations. And a lot of times they've been burned. They've had bad customer experiences, failure of ROI. And so I think that they're asking hard questions, but this is also coming at the same time that they have significant business needs. So you're seeing customers being more demanding, asking smarter questions, and at the same time trying to be a little more, I think, thoughtful about how they're building their people tech stacks.
Yeah. And you just ran a survey, your team just ran a survey about buyer patterns and behaviors. And one of the things that stood out to me about that research that came in, I think it had like 700 or 800, no, I'm thinking on the HR side, because we've got a lot of, sorry, folks, we have a lot of research going on all the time. Sometimes we're researching work tech buyers. Sometimes we're researching work tech vendors. But there was a stat that you released about the number of people who want to change the work tech stack they have. And what was that number like?
Yeah, I think it was like 63% are in market to change their work tech vendor, or would change it if it could. And that is, to give credit where credit's due. That's not our stat. That's from Sarah White at Aspect 43.
Oh, that's right. And so a couple of years ago, we said, hey, there's a new organizing principle at play. It's going to result in the most significant moment of solution switching in history. And it seems like that's manifesting right now. Like people are switching more aggressively than they ever have.
Yeah,
so
they are.
Just continuing to follow the breadcrumb trail, more investment than ever, more competition than ever, and more buyers switching than ever.
Right.
And also more buyers than ever.
Mm-hmm.
And to the point that, because it's not just, people, like the market's not stagnant. It's not just people switching from vendor A to vendor B. It's all these new buyers coming to the market at the same time, because we're seeing compound annual growth rates that are like 20, 25% in a lot of these categories on average.
Yeah.
So everything's growing at the same time that there's a lot of switching going on. We talk to vendors all the time who complain about churn, but in the same breath they complain about churn, they say, well, and thank goodness we're also growing our top line 15 or 20%, because for every, client or customer that we lose to a competitor, we're closing 3 or 4 more new deals. And so it's just a very like high growth, volatile, big switching, moment in work tech history, at the same time that we have tons of investment, tons of competitors. And to your point, which, should not be under considered or ignored, these are not the buyers that we had 10 years ago. And 10 years ago, the buyers were more sophisticated than they were 10 years before that.
Mm-hmm.
But now, not only do we have sophisticated work tech buyers, sophisticated not only from like an actual technology perspective, but sophisticated in terms of how the technology comes together with their business objectives to achieve an outcome. On top of all that, they've all been through the crucible of the pandemic, and ain't nobody got time for any bullshit these days, right?
Right.
And so 10 years ago, we used to say and complain about a lot of vendors hated their buyer. They hated selling to HR. Mm-hmm. And they perceived that HR was not sophisticated, that they had to hold their hands through the buying process. And, probably half of the companies that we ran across loved the business that they were in, but hated the market that they were selling to.
Yeah.
And that's no longer true. What I've heard a lot of is that one of the biggest challenges that organizations have is keeping their subject matter experts and salespeople on par with the sophistication of the buyers who are coming to them, which is, unprecedented. And so, incredibly crowded market with tons of investment, more sophisticated buyers, biggest switching moment in history, et cetera, et cetera. And for me, this creates many opportunities and challenges for shareholders and vendors in the work tech space. And I'd love to get your opinion on this, but I think chief among them is, let's bring in the macroeconomic situation. In the macroeconomic situation, buying behavior, despite everything that we just said, buying behavior is incredibly fickle and variable. And so one month you'll, talk to organizations and it's like they can't keep up with sales in their market. And the next month their pipeline has stalled. Everyone is, pushing deals out, delaying stuff. The next month it changes again. And so I can't remember a period where, buying behavior and variability happened in such short intervals as it's happening now. Can you remember any time like this?
No, I mean, this is really unusual in that regard, because I think that, there certainly is a lot of hurry up and wait in terms of buying timelines. We're seeing, basically deal cycles extend, but this is also happening at a time that we've got tons of benchmark data on industry media performance. We're talking to customers and prospects all the time. It is very clear that all of that money in market, combined with kind of this fickle market behavior, is driving up cost of customer acquisition. It is making conversion rates in digital media far less effective. I mean, like month over month this year, seeing significant declines. And it's just making it harder for sales and marketing people on the front end of the customer experience process to make their numbers.
Yeah, and I would say what makes it even harder is that a lot of companies in the marketplace right now are kind of they're almost like Jekyll and Hyde, right? They at the same time that they believe and understand the growth of the sector that they're in. So we're all looking at work tech and we're saying work tech looks robust and healthy, and yeah, it looks a little weird because there's just like shorter and shorter intervals of volatility. But overall, it looks like it's going to be a 10-year growth opportunity. At the same time, private equity companies, venture capitalists, board members, shareholders are looking at the macro environment and saying, yeah, but it's a really challenging environment. So you get into this conflict where it's like, how do you take advantage of a growth market when you also feel the pressure to appease the board and appease shareholders by appearing to be, agile, resilient, and reactive to what's going on in the macro economy.
Right.
And to me, that's what's driving, that's what's going to, like in moments like these, new leaders emerge. We always use the Salesforce example. They didn't exist until 2001. Now they have the tallest skyscraper in San Francisco, and it happened just like that.
Right.
And that was all driven around this organizing principle of, software as a service and cloud. People were on one side of the line or the other. We're in another moment like that, right? Where, some very large organizations, going back to remembering companies like Lawson back in the day, right, some very large organizations are at risk of blinking out of existence. Right. And some companies who didn't exist 2 years ago may have the tallest skyscraper in San Francisco 10 years from now. Right. And so there's this creative tension for work tech leaders, for boards, for shareholders, for, executives, around taking advantage of the opportunity that's presented by the market and everything that we experienced during the pandemic, weighed against responsible fiscal management as, kind of projected by everyone's hand wringing around the macroeconomic situation. And I'm curious, how you feel about this. My view is that I believe that a lot of people think they have it under control. Yeah. And I think they're so good at blocking and tackling, they've got the right, marketing program. They've got the right MarTech stack. They've got the right funnel dynamics. They've got the right sales process. They have the right Salesforce automation software. And they're in the mindset that they can pull back, right? Because they're so good at blocking and tackling. And that when things look brighter, they can turn everything back on and just, increase volume at the front end of the funnel or the pipeline or whatever. And that they're going to time it right, and they don't have the risk of losing ground, and they don't have the risk of missing the opportunity to gain ground, during this period of uncertainty. And my view is rather different. My view is that blocking and tackling are table stakes now. Industry media is completely saturated. and the notion that you are in control of the pipeline based on quantity metrics of how many impressions you create, how many inquiries, MQLs, SQLs, etc., that those days are gone forever.
Yeah.
And what I think people are, to quote a famous politician from back in the day, misunderestimating. What people are misunderestimating, which is a perfect word when you think about it, because it is the combination of misunderstanding and underestimating. It kind of makes sense in this context. Is that it's not just that all of that thinking is based on this flawed notion of purchase intent, that when you're ready to turn your machine back on again, all you have to do is find people with purchase intent and get them in the funnel, and then everything's going to be just like it always was. I think that's a flawed convention, but it also misses the connection of brand and marketing and sales with product and customer success. So I think people are also missing this holistic view of how all this stuff works together. And they really need to be thinking about creating great customer. We call that customer experience. Customer experience has 5 subdomains: brand, marketing, sales, product, and customer success experience. And I think people are not aware that creating great moments in customer experience now is critically important as a hedge against volatility and variability in the macroeconomic situation, because you can't just flip the switch and turn everything back on again, because that switch that you're flipping on, so are 100 other vendors in your segment. And it's a volume game, and very few people can win the volume game. The way to actually create a great customer experience and sustainable business success during volatile times is to invest in creating a great customer experience consistently all the time. And some months these days, right now, that means creating a great customer experience in brand and marketing and sales, even when you don't expect people to go all the way through the sales process and actually become a customer.
Yeah. And I think that, you're touching on something really important here. In sort of that blocking and tackling view of the world, there's often, a focus on the so-called demo-ready lead. So basically a prospect that has buying intent, understands what they want to buy, and they're just evaluating different options ahead of making a purchase. And in reality, I don't think in work tech very often you're going to get that buyer. I think that there's enough research out there that demonstrates buyers have early favorite vendors based on their brand experience and the marketing experience that they've had with a particular company ahead of ever being in market for a solution. And this whole idea of we're going to put, X into our, marketing engine, and we're going to produce Y in terms of pipeline, and we will close Z in terms of closed won business. That fits really nicely into a spreadsheet driven view of the world that makes the board happy. It's just a world that I don't think exists anymore.
No, it doesn't. I mean, how many times do people have to see all this data coming from all these, analyst shops that basically says, 90% or more of buyers, when you find them, have already established an early favorite vendor. They've already done 90% of their research. They're already predisposed towards someone before people actually start thinking about how to action that information. And I'll take it even further. The buyers who come into your pipeline and close in 30 days, the ones with high purchase intent that you actually win, they're not the customers you want. Right. Because that's basically a hair on fire. We've got to, pick a solution in a short period of time, and we don't have a clear vision for what we want, and we don't have an early favorite vendor, and we haven't been talking about this a lot. So if somebody comes in and buys enterprise software because they, were served an ad on Google AdWords and filled out your form and downloaded a white paper, and now they're in your pipeline and you're closing that deal, those are the ones who end up turning customer success into a triage function instead of a true customer success function.
Right.
Because those folks, those buyers are figuring out what they want as they're buying. And you're basically going to be the solution that they learn on. They're what we would call, going back to a previous conversation that we had, an unsophisticated buyer. Right. A sophisticated buyer is not going to download something after seeing an ad on Google and then sign a contract with you 30 days later. And the number of unsophisticated buyers in work tech right now is very small compared to the number of sophisticated buyers. And an unsophisticated buyer tends to have an unsophisticated relationship with your product and your customer success team, and they churn much more easily than someone who knows what they want and they do their work and they go out and find the solution they want.
Well, and so think about that from a customer experience perspective. You know, if you are building your, brand marketing and sales engine to attract those unsophisticated buyers, you are actually inserting a lot of terrible things in the process. You're building your engine to acquire terrible customers, but it doesn't matter because you have lowered your cost of customer acquisition. But then on the back end, you're basically laying the groundwork for churn.
That's right. And so I'll go even further and say it's a classic case of surrogation where numbers become surrogates for the strategy.
Right.
You shouldn't be pursuing, and we're going to get a lot of shit for this. You shouldn't be pursuing a lower customer acquisition cost right now, because a lower customer acquisition cost portends a lower value customer and a lower value buyer. You should be investing in building a great customer relationship prior to them becoming a customer. And that drives all kinds of beneficial outcomes in the holistic view of customer success or customer experience, versus this, like, we need transactions. We need to show our ability to acquire at a low cost. It's like you get what you pay for.
Well, there's nothing wrong with a low customer acquisition cost if there's a quality metric attached to it. If you're building that relationship, if you've identified the right, ideal customer profile, if you're bringing in the right kind of business and they understand what is the post-sale experience going to be like, what's the product going to deliver for them. If all that's been calibrated effectively up front, of course you want to get the lowest possible CAC that you can get, but it's just like if you're pursuing CAC, on the front end in the absence of what happens after, the close, then you're basically setting yourself up for heartbreak and disappointment.
Well, I'm so glad you brought that up, because that reminds me, like, going way back in the Wayback Machine, of Dr. John Sullivan, who always distinguished between numbers and metrics.
Right.
And Dr. John Sullivan back in the day would say, look, a metric has 5 variables that you can draw from: quantity, quality, cost, time, and satisfaction. It's not a metric unless you combine multiple of those things. CAC is a quantity only metric. Right. It's a cost and quantity, right?
Right.
And that's it. But it lacks any notion of quality. And so it's almost like there should be a quality customer acquisition cost metric. And, just to put that in perspective, it's not that the notion of CAC was flawed. It's that the notion of CAC, when it existed in a market that was wide open and every customer was a good customer, is very different than where we are now, where you don't want to acquire the cheapest customers to acquire. You want to acquire the quality customers, because that drives all of your net retention and, all of the other downstream metrics that drive shareholder value. And I think there has to be some recognition that the perfect metric for the 90s is not the perfect metric for the 2000s. And that's not the, perfect metric for the, certainly the 2020s, when no one knows what the fuck a metric should look like right now because of all this volatility.
All right. But I want to pile on that, because I think that, traditionally when you were looking at investor pitch decks, you would have a number around customer acquisition cost, and then you would have a number around customer retention. Yeah. And so I think the idea was that combined, what that is telling is a story of growth that does kind of capture that, that quality. It's just like, great, we've got our CAC keeps going down and our retention is at 90%. 95%, 99%. It's just like every investor deck you're looking at has these crazy high retention numbers. But you go and back to that, stat from Aspect 43, 63% of, work tech customers are in market for a new solution. So it's just like,
what's that telling you?
that's telling me that those retention numbers are bullshit. And I think that they've always been bullshit.
Well, I mean, gross retention versus net retention, right?
Right.
It's like if you retain because you're growing, 90% of your revenue on an annual basis doesn't mean that you're actually retaining 90% of your customers on an annual basis, because if you're looking at retention of revenue versus retention of customers, that's a very different situation.
Right.
In a growth period like this, where the market's growing and people are switching left and right, your retention can actually look pretty good, because what they don't put in the footnote in that slide is we're talking about revenue retention. We're not talking about customer retention, right? And so there's almost like this inverse correlation now between customer acquisition cost and true customer retention, where the lower your customer acquisition cost is, the probability that you're not retaining actual customers as opposed to revenue is a really different situation. It's like lower customer acquisition cost is greater churn. And people aren't talking about that because everyone wants to, in this environment where it's all about raising money and driving growth, and to that point that you made earlier about the creative tension, I should stop saying creative tension because I say it like 80 times, but where, the market is
creatively tense, Brett.
Yeah, me too. Where the market is talking more about like, okay, growth is great, but we want to see profit. We want to see, it's like, well, that dimension's changing a little bit, which points to a greater maturity in the market. But we're still in a transition period where, people will make the numbers tell the story that they want. And you have to be on guard against, a story told by numbers as opposed to the actual story that is told by the right numbers. And I think the right numbers change based on the maturity of the buyer, the maturity of the market segment, the competitiveness. And I think the stuff that worked from a blocking and tackling perspective of creating, like, what was the Salesforce, model that like predictive revenue or something like that? This notion that you would be able to predict revenue based on upstream outcomes. Well, that was great, in 2005, 2005. It's not great in 2022. It's just not great. It's a different game. The game is more holistic. We have to look beyond blocking and tackling. We have to start sweeping up, brand and marketing and sales in our discussion of customer experience, as opposed to just viewing customer experience as, the combination of product and customer success, because most of the relationship with your customer is created prior to the sell. Right. And, the metrics won't point you in that direction.
Right. But let's kind of like, kind of bring this around, because, what is, absolutely true is that work tech as an industry lags, B2C type companies and customer experience by at least 5 years, if not more. If you think about the kind of customer experience you have with consumer brands that, you buy from frequently, or that you have a relationship, whether it's your airline or, department store, sporting goods, whatever, and you think about, how they are communicating with you in the, just kind of throughout, your ongoing buying journey of buying multiple products from them, how they're surveying and how they are really, really personalizing and creating an experience that, that more blocking and tackling view of the world is not doing anything to serve you up for basically the reality that work tech companies are definitely finding themselves in now, and are going to find themselves increasingly being beholden to over the next decade.
Yeah. And so here's my message to boards and shareholders and executives. You've got to make room for your brand and marketing and sales team to raise their game.
Right.
And raising their game beyond blocking and tackling requires investment. and it requires investment in uncertain times, because that is actually your hedge in uncertain times for creating a great customer experience. And so when you're in a situation where, people start throwing around phrases like keep your powder dry, and what are some of the other cliches? We've got to do some belt tightening, we got to blah, 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 blah. Yeah, totally. Everyone needs to respond to a macroeconomic situation in a way that shows fiduciary responsibility. But part of that fiduciary responsibility is setting yourself up to beat your competitors, right, and gaining dominant market share. And you're not going to do that if you think that you have this assembly line in brand and marketing and sales that you can just turn on or turn off and get the high quality customers that are going to engage with your product the right way, and create an environment for customer success, where instead of having conversations with one after another unhappy customer, they're actually having conversations about expanding their usage, driving their business goals, and buying other stuff from the company. Mm-hmm. And so, this is going to be a moment where I think brand and marketing and sales folks ought to be going to the board and going to executives and saying, this is not a do more with less proposition. Mm-hmm. This is, we need to invest in a sustainable customer experience. And that means aligning brand, marketing, sales with product and customer success, and investing in relationship building, even as customer acquisition cost looks volatile in the short run, because it's over the long run that quality customer acquisition cost ought to be measured in an environment like this. And frankly, I'm not sure this volatility is going away.
Yeah, I mean, there's definitely a scenario where this could stretch all the way through 2023.
Well, I'm going even further. I'm just like, in our own segment, the work tech vendors have talked about for over a decade creating agile, resilient organizations. And so this brings into question, what does that mean? And I would say, when the actual buying behavior is no longer viewed in terms of a year, not even in a quarter, but month to month and week to week, creating agility and resilience means always focusing on creating a great customer experience, even when the time frames for people actually tipping over into being a customer, as we would traditionally call it, versus being someone who's just, having a great experience with your brand, is less predictable. Sometimes it's going to take longer and sometimes it's going to take shorter. But that volatility, I think is going to last for a decade, where, we can't predict outcomes based on having our blocking and tackling put together the way that we used to, because the market is just too crowded, just too sophisticated, and there's too much change being thrown at us all the time now. So,
well, and I guess with that in mind, Brett, as work tech companies are looking to raise their game in customer experience, what does that look like?
Well, I mean, first of all, we just came back from a senior leadership, offsite where we spent 3 days together. And in those 3 days, we didn't just talk about our biggest problems or our biggest opportunities in isolation. Right. We scanned our business from an employee experience perspective, a customer experience perspective, and a shareholder experience perspective. And we looked at all the subdomains of each one of those. So on customer experience day, we were looking at the brand experience, the marketing experience, the sales experience, the product experience, and customer success experience all together, right? Mm-hmm. And so in short, to answer your question, raising your game, number one, requires looking at your decisions in a holistic framework, right? Mm-hmm. And we found so many things where, it's not like the knee bone being connected to the thigh bone. It's like the knee bone being connected to the neck bone through 5 other bones, right? And so a lot of problems or opportunities that we thought were localized or, myopically focused on marketing or sales or whatever, actually had all these upstream and downstream connections to other things, where the solve or, the way to pursue the opportunity was actually located not just in one subdomain, but in 3 or 4 or all of the subdomains. Like we were talking about a functional association opportunity where it's like functional association is, okay, so if you think about brand is, you can break brand down into three dimensions: recognition, functional association, and brand attributes. So do people know who you are? Do they know what you do? And do they know what you're like, right? And so a lot of people out there, don't have a broad functional association for the Star Conspiracy. They think that the only thing that we do is the thing that we did with them, right?
Right.
And so the natural, motion there is to think about functional association from a brand and marketing perspective only. Like, how do we market to the world and tell them, here are all the things that we do? How do we create a brand that is broadly recognized and also recognized for everything that we do? Well, the reality is when you're having a holistic conversation about all of the subdomains in your customer experience, you realize, as we did in our particular, assessment of that opportunity, that functional association is not something that you solve in one subdomain. Right. It's, you have to talk about it in terms of the products and services, like the actual experience, because a lot of times in software companies, your customers don't know everything that you do. And, they didn't learn it in brand. They didn't learn it in marketing. We realized, and this is very common with companies in all, types of, industries surrounding work tech, right? We realized that we probably spend, in a year with a single client, we probably spend about 15 minutes talking about everything that we do. And it's a couple of slides and a presentation, a first meeting, and sales, right? So you think you're going to solve that problem by adding 2 slides? You think you're going to solve that problem by changing, one of your marketing threads to promote your functional association? You think you're going to put out a brand campaign that suddenly makes people realize everything that you do? No, you have to do all those things. You have to attack it in brand, in marketing, in sales, in the actual delivery of the product and service, and in the customer success function, which is constantly talking to customers about, how they're using you now and how they could be using you for the same business objectives, but with different tactics, or other business objectives that they may not have considered that you have a solution for. And right. So raising your game means, number one, looking at things from a holistic perspective, which in our opinion is a customer experience perspective. And number two, it means going beyond blocking and tackling, because we've got these beasts to feed in, marketing and sales, right? We've got this marketing automation system that produces 0.05, whatever, right? Percent conversion rate. And our mind frame right now is, well, if that's going to be our conversion rate, then we need to increase the volume of impressions that we create in order to get the number of SQLs that sales needs to consume. But there's not really any moment where you say, well, instead of just increasing the volume, what if we actually tried to create a defining moment where we could actually do less and achieve more? And I don't mean like do, less from an investment perspective. I mean, like, you don't have to send 10 campaigns a week to hit your number if you send one really great campaign. And so I think we all need to slow down a little bit and look at all the stuff that's flying around the world, all this content, all these calls to action, all this stuff, and say, well, how do we elevate, some of these campaigns so that they create defining moments? And, every year somebody says, well, our best performing campaign was this one. And you kind of double click on that campaign, and maybe it got a 5% response rate against an average of a 0.02% response rate, right? And when you say, well, why was this a 5% response rate? Well, it's because something was special about it. And maybe it was an accidental thing that it was special, but there was something special about it, which proves that it's possible. And I think people need to spend more time looking beyond the blocking and tackling and the creating the content that you need to create, and, the promotional stuff to promote, to promote the content, because that gets you in this motion of good enough. Right. It's like, we've got to get 5 campaigns out a week. That content's good enough because all we need is a 0.5% response rate, and rather slow down and say, why don't we let's just take a few of these things and create something that represents a defining moment for our buyer and the customer experience perspective. So I'd say look at it holistically, number one, how all the connective tissue works. And number two, stop feeding the beast and instead say, how do we create defining moments so that we can drive higher levels of engagement and just better experiences, as opposed to just, because people tune out, like as you increase the volume of what you're doing, you're increasing the odds that people are going to tune out, because what they're really judging is, from a behavioral economics perspective, is it worth my time to even pay attention to this email that I just got, or this, whatever that I just got, because the last 5 times I looked at it, it was some like listicle of the top 5 things you need to know about, this. And the amount of value that adds to someone versus the amount of effort of sifting through everything that you send, there's a point of diminishing return where people just tune out. So there's probably 10 more things after that, but I'd say number one is think about what you're doing holistically in terms of the entire customer experience. And number two is focus on creating defining moments that rise above the need to just feed the blocking and tackling beast. What do you think?
I agree.
Okay. Well, on that note, Steve, it was great talking to you today.
Great talking to you as always.
Hey, I always forget to say this, but if you found this conversation valuable, please do what you're supposed to do. I don't even know what it is. Hit the subscribe button, like it, wherever you're listening, however you're seeing this. Some people are watching on video. Some people are listening on audio. Whatever you can do in that context to make sure that you're aware when this content is published, because a lot of times it gets published before we promote it. Will ensure that you get access to the stuff as it comes out, and that you're aware that it's out. So we appreciate you taking that extra step, and thank you for your time today. And Steve, I look forward to getting together again with you next week, and we're going to start bringing some more people into our conversations. I'm very excited about that. So looking forward to that. Yeah, keep your eyes open for some special guests that we're going to be having join us. And coming to our broadcast over the next several weeks and months.
Rock on.
Rock on.